Next question, C 2.1.5. RM Steel Limited requires a 10 lakhs for construction of a new plant. It is considering three financial plans. The company may issue 1 lakh ordinary shares of rupees 10 each and total equity. Option number 1. ₹10 lakhs equity. Option number 2. The company may issue 50,000 ordinary equity shares as 10 per share and 5,000 10, that is 5 lakhs rupees equity and 5 lakhs rupees debt. And debt 8%, 5 lakhs. Please understand, total should always remain 10 lakhs rupees. We are not doing capital budgeting decisions or any other decisions. We are doing capital structure decision. What should be combination of debt and equity? Option number 3. The company may issue 50,000 ordinary share, 10 each. 5 lakh rupees equity and 5,000 preference shares of rupees 100 each, 8% dividend. 5 lakh preference shares, 8% dividend. So these are the three plans. So what does the question says? If RM Steel Limited's EBIT are 20,000 or 40,000 or 80,000 or 1,20,000 or 2 lakhs. So in each situation you will have to find out the answers. See, this is May 2019 question and it is of 10 marks. Why 10 marks? It requires lots and lots of working. You are required to compute the earning per share under each of three financial plan. Which alternative would you recommend and why? This will be important. Tax rate is 50%. For you, it is a very lengthy question. For me, it is very simple because I am having an Excel sheet. But you can easily understand what I am doing it in what I am doing in Excel sheet. So what is total capital required is 10 lakh rupees. Situation number 1 is option 1. And 100% is equity. So no debt, it is less risky plan. Tax rate, I think, is given, which is 50%. Debt is not there in option number 1. Let us go to option number 2. 5 lakhs equity. And cost of debt is 8%. In option number 3, 5 lakhs equity. And remaining 5 lakhs is not debt, is preference shares. So preference shares, 40,000 will be preference dividend. And interest will be 0. Cost of debt, I'm deleting it. Instead of debt, it will be preferences. So this is less risky. this is most risky, and this is average risky. Why? Higher the debt proportion is most risky. So let me even write it down over here. This is most risky and this is least risky. All right. So what they want us to do? They want we should find out EPS if EBIT is 20,000. Let us first take in all three situations. If EBIT is 20,000, what will happen? Let me write down EBIT as 20,000. In first case, I'll have to find out number of shares. Number of shares will be 1 lakh in first case, 50,000 and 50,000 in second and third case respectively. So if my EBIT is 20,000, see in case number 1, my EBIT is 20,000, earning before tax will be also 20,000, tax is 50%, 10,000, so EAT is 10,000, preference dividend is 0, so earnings available to equity shareholders is 10,000, number of shares are 1 lakh, and so earning per share is 0.1. But in option number 2 and option number 3, the answer of EPS is negative. So which is the best plan? Best plan is the least risky plan. Why even I tell you? What is your ROCE? 2%. So in plan number 1, if EBIT is 20,000. Believe me, R is less than KE. R is 2% and KD is 8%. R is less than KD, so always least risky plan will be there. What was your EPS in that? This case is 0.1. If EBIT is 20,000, what is EPS in this case is minus 0.2, and EPS in this case is minus 0.6. Option 1 will be best. Let us go to another situation where EBIT is 40,000. So as far as you are concerned, if this question is asked in examination, you will have to write down everything again and you will have to solve everything again. But for me it is easy because I just need to change this figure, which is 40,000. What will be my EPS in situation number 1? 0.2. Here it is 0. And here minus 0. If my EBIT is 80,000, EPS is 0.4. In most risky situation also it is 0.4. And in average risky it is 0. Let me write it down over here. If EBIT is 80,000, my EPS 0.4, 0.4, 0. Please understand, I was knowing that these two figures are going to remain same. See R in this case. What is R? 8%. What is R is? 8%. R is equal to KD. So risky and non-risky plan will give you same EPS. Remember that trading on equity. Let me go ahead with my sum. If my EBIT is 1,20,000, there will be trading on equity concept 1,20,000. What will be my EPS? In first case is 0.6. Second case is 0.8. Third case is 0.4. If my EBIT is 2 lakhs, if my EBIT is 2 lakh, EPS in first case will be 1. Second case will be 1.6 and in third case will be 1.2. Please understand the situation. For you, this will require minimum 20 to 25 minutes of calculation. I was having Excel sheet, so it is extremely easy. Also, this is good question to understand trading on equity. Please understand, let us forget option 3. There are different situations given. What is R in this case is 2%, R in this case is 4%, R in this case is 8%, R in this case is 12%, and R in this case is 20%. In first and second situation, that is this and this, R is less than KD. R is less than KD. You are having unfavorable leverage, so you will always be going with less risky plan. This is less risky, this is more risky. And please understand, you are never selecting that preference shares plan. If R is equal to KD, which is in this scenario, R is also 8% and KD is 8%. So your answer in both the case, you will be indifferent. And in these two cases, R is greater than KD. If R is greater than KD, you will always opt for more risky, higher debt option, which is this and this. So a very simple idea, if R is less than KD, go for less risky option. If R is equal to KD, go for any option. If R is greater than KD, go for higher risky option. This is nothing but trading on equity, a practical question on trading on equity. They are also asking us in the question why. You should write down. In situation number 1 and 2, R is less than KD, so you should go for less risky option. That is option number 1. In situation number 3, R is equal to KD, you are indifferent. Between option 1 and option 2. And in situation number 4 and 5, R is greater than KD, you should go for more risky option, which is option number 2. And this answer of this Y is nothing but answer of trading on equity. Sir, preferences does not play any role. Whether R is less than KD, R is greater than KD, preference shares will not come into picture. Preference shares will always be an irrelevant idea. The answer is no. Here it is irrelevant because it is 8%. See, if preference shares and debt both are at 8%. If preference shares was very low, say 1%, 2%, then in some of the situation you might get option number 3 as answer. But as debt and preference is one in the same, right now it is irrelevant. Either you will go for option 1 or you will go for option 2.